Thomas did a great job. Let's not forget, he took over in one of the most challenging periods of Credit Suisse. He put us back to a more stable underlying platform, but now it's time to move on.
The markets are awaiting sort of the next set of central bank actions, including today from the Fed, and then we'll see how the tone develops.
We are, of course, watching central banks' reaction to that inflation with interest hikes. So it's something that we have to be mindful about.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Good morning and welcome to Bloomberg Surveillance Early Edition. I'm Tom McKenzie in London, stepping in for Francine. Here's what's coming up on today's programme. Gottstein gone. Credit Suisse trades higher after the bank replaces its embattled CEO, despite losses coming more than seven times forecasts.
Thomas and I came to the conclusion that it is better to have new leadership. We were, as a company, under fire, and he, as a CEO, was under fire. He did a great job, but he decided to step down.
UniCredit shares rally after second quarter profit doubles expectations. The Italian bank upbeat looking ahead despite the political turmoil. And don't forget the Fed markets see another 75 basis point hike today. But the question, what comes next? Well, that looms ever larger. Treasuries tread water while the dollar dips. Let's check in then on these markets. As the way up then, the central banking action we're expecting out of the Fed later today. And of course, a mixed picture when it comes to earnings. Broadly, 3/4 of earnings so far have either beaten or come in line with expectations. Across the benchmark here in Europe, we're seeing gains of 0.4%. That mixed picture, particularly when it comes to the bank stocks, the likes of Credit Suisse on one end, UniCredit outperforming on the other. Technology in focus for us today, getting 1.3%. You had some optimism in terms of Alphabet, a beat there in terms of ad sales. So pushing back on that overall concern that we saw from the likes of Snap and Twitter. Microsoft also giving a very strong outlook as well for the quarters ahead. The cloud services part of the business, that demand, even as growth starts to slow stateside. And we had that warning again in terms of consumer sentiment with the latest survey showing that fell to the lowest levels since about early 2021. The Bloomberg Dollar Index in focus for us today, of course, ahead of that Fed decision around 75 basis points. That is the consensus. So currently lower by about 0.1%. Bitcoin, 21,347. That's a gain of 1.7%, of course. Let's switch it on and see how things are going to play out then in terms of the map. Geographically, we're looking at Italy as well. You see the Italian FTSE MIB, that has bolstered. We're not seeing it now, but the FTSE MIB has been pushed higher as a result of what we saw from UniCredit. Optimism there. On the banking front, there's Italy gaining 0.7%. On the macro front, you did have a downgrade, a lowering at least, of the rating from S&P. So yields up, BTPs up. UK, you're seeing gains of 0.5%. The CAC current is higher by 0.2%. Germany higher by 0.2 as well. So broadly optimistic, gains of around 0.4%, as I said, across the macro. The gas picture still a factor as well. And Goldman Sachs telling us earlier they now see a recession in Europe as the base case. We're going to have a look at Microsoft and Alphabet again on the back of that guidance that we got, very strong guidance from Microsoft. Alphabet shares gaining 4%, of course, post-market, and Microsoft, you're looking at gains of 3.8% pre-market. I should correct myself, pre-market. 3.8% for Microsoft, an outlook exchange in terms of outlook guidance being raised by that company. Again, Alphabet, a beat when it comes to ad sales. OK, the earnings deluge continues with big banking names like Deutsche Bank, Credit Suisse and UniCredit releasing numbers this morning. We talked about some of those, UniCredit, of course, and Credit Suisse. Credit Suisse has brought in a new CEO after more than 1.5 billion francs of losses in the second quarter.
We are going to refocus our investment bank into a highly competitive banking business and a much better aligned markets business. This is work under progress, and we will report to the market with the third quarter result. Conclusion, that it is better to have new leadership. We were, as a company, under fire, and he, as a CEO, was under fire. He did a great job, but he decided to step down.
OK, meanwhile, Deutsche Bank issued a warning on costs and inflation. UniCredit, on the other hand, raised its guidance again, after profit came in at double estimates. Let's check in then on those banks now and see how they are moving in the session. UniCredit, look, you're seeing gains there of more than 6%. That is supporting the FTSE MIB over in Italy. Deutsche Bank down by 2%, currently 17 points lower for that German lender. Credit Suisse is actually gaining 1.7% despite that terrible set of results. Of course, a third set of a miss is when it comes to the quarterly profits for Credit Suisse, but you have that change at the top, and that maybe is proving cathartic, as Manus Krenny, who's been speaking to the chairman, has said. A bank under siege there over in Switzerland, currently gaining at 2% on Credit Suisse. OK, let's bring in Luke Hickmore now, Investment Director at Abrdn Investments, who joins us from the beautiful city of Edinburgh. Luke, good morning. Thanks for joining us. What is your assessment then as we work through these earnings and as we start to move away from that multiple compression story, the valuation story, arguably to a story more about earnings?
Yeah, it's an important Q2 season, I think, this one. You know, we're still seeing reasonably good. We're still seeing reasonably good outlook statements from companies. They're broadly upbeat about the future, but the tone is changing. And, you know, as you were talking to your BI analyst from Singapore earlier on, they're starting to see a bit of stress around where EPS is coming in and, you know, how many are actually not beating this time around. It feels like Q2 could be the peak in terms of earnings, and we get through Q3 and Q4, and that risk of recession really starts coming to the fore, and reality starts hitting, and we see companies' results deteriorating from there. Start to see analysts move in that direction. We've seen an increase in downgrades coming through, but that's not at the pace that you'd expect quite yet, given the amount of people who are now turning towards a recession as their base case for 2023.
So maybe some further downgrades for some of these companies. The erosion of margins, Luke, where do you expect to see that most pronounced as you look at that credit space?
Yeah, I think there are some really good industries who are very good at avoiding margin volatility. Industrials is a great example. They're able to pass on their costs, and they've shown over many, many years that they could do that. Retail, very much not the case. Walmart the other day, pretty horrible. We're going to see margins come under pressure in that space again and again and again, not just staff costs, supply chain problems, all of that hitting them just at the time when they want to see a recovery post-COVID coming into their bricks and mortar stores. So yeah, I think if you are close to the consumer and you're close to lower paid consumers, those are the biggest risks, both from a revenue perspective and from a margin perspective.
Luke, we were speaking, our colleagues in the US were speaking to Nouriel Roubini yesterday, painting, not surprisingly, a pretty dire picture of the global economy, talking about debt crisis, huge number of defaults. Are you concerned? Is any of that kind of ticking any boxes with you? Are you concerned about the default picture in this recessionary environment with tighter liquidity across the board?
I think it would have to be a much bigger recession than we're expecting. At the moment, we're expecting quite a mild one, maybe in a 0.5 to 1% bracket. You need to see much bigger to really stress company balance sheets, because I think coming out of COVID, a lot of companies have been actually quite cautious. They haven't really leveraged up. They haven't gone out and done massive CapEx plans. They've come out of it cautious, careful, thinking about the risks, and suddenly we're hit. You know, Russia's problems. Well, Russia in February changed people's minds completely about the risk of recession in Europe. I don't think we're going into that with companies stretched and finding things tight from a financing perspective. So no, I don't expect a big jump in defaults, whether you're talking in leverage land or a drop down from investment grade ratings for a lot of other companies as well. And in that sense, this could be quite an unusual recession.
OK, interesting. An unusual recession that we should be looking at, possibly looking at. We were speaking to BlackRock earlier, Luke. They were saying they're starting to see flows into investment-grade European credit. Are you getting enough clarity from the ECB to kind of take a nibble on the edges when it comes to investment-grade European credit?
Yeah, I think in a sense, both the ECB and the Bank of England, they're going to be reducing the amount of corporate bonds they own over the next few years. This is well known. And the quantum and when that happens, of course, becomes quite important. If it gets tough in Europe, if that gas flow really gets tight and shut off more and more and more, I think the ECB probably paused in their quantitative tightening plans, and that could be quite a boon for European credit. And actually, in the meantime, there's a lot of cash on the sidelines. We've seen new issues, just a few this week, which is, fairly unusual for what is summer months. And they've been taken down very, very well with massive books and a lot of interest. It clearly is a lot of cash on the sideline. And, I look across European investment grade credit, and you could get 3 to 5% yield from great businesses, people like Digital Realty, the cloud storage company, close to a 5% yield. That's a fantastic level for investors.
Okay, cash on the sidelines, 3 to 5%, a decent yield. That is the call from Luke Hickmore, who stays with us, investment director at Abrdn Investments. We'll get more of his calls on the Fed and, of course, how to position across credit within these markets. Coming up, it might be a major day for earnings, but there is, of course, still plenty more on the agenda, including that Fed decision. We will look ahead to that next. This is Bloomberg. Welcome back. Happy Wednesday. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Tom McKenzie in London. Let's get the first word news now with Leanne Gerrans. Leanne.
Happy Wednesday to you, Tom. Now, the IMF has cut its growth outlook for the third time this year, warning that the world economy may be soon on the cusp of an outright recession. The fund expects global GDP to grow 3.2% this year. In January, that forecast was 4.4%. It says consumer inflation will hit the highest level since 1996. Now, Bloomberg has learned that President Joe Biden will speak with Chinese leader Xi Jinping tomorrow. The call comes amid fresh tensions over Taiwan and the possibility of a visit to the island by House Speaker Nancy Pelosi in early August. Beijing has warned it will take resolute and strong measures against any visit. In China, a district on the outskirts of Wuhan has been locked down, affecting around 1 million people. It is the first time the city, which saw the world's first lockdown, has faced new restrictions for 2 years. Authorities gave the order after 4 asymptomatic cases were found in the area. It's Fed Day and the market is on edge for a rate hike that is widely expected to be 75 basis points. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Tom.
Leanne, thank you very much. Thank you for picking up the Fed for me. Yes, as you said, 75 basis points, of course, is expected from the Federal Reserve when they make that decision later today. Luke Hickmore, investment director at Aberdeen, is still with us, joining us out of the city of Edinburgh. Luke, you're looking at peak rates. This is your assessment of 350 by next year. My question to you then is, what does that do to US credit spreads?
Yeah, I think actually US credit spreads look a little bit on the rich side. That's not a popular view, and it's really come from how both Europe and sterling spreads have reacted to higher and higher yields. They've followed them higher, and particularly in Europe, it's been pretty horrible for the last 3 to 6 months. Dollar's not been great, but actually they seem to have been okay with that. They haven't gone as much as quickly as we've seen in both euro and sterling. So, from a 150 kind of area for investment grade in the US, you could easily see a move out to 180, even 190. And if we do get that recession come through, you could be touching a 200 spread in US dollar investment grade, I think, over the next 6 months to maybe 8 month kind of period before we see the peak and it starts recovering back down the other side.
And Luke, do you see that recession threat? Does that derail the Federal Reserve? Is this the Fed that pivots? Or is this the Fed that has inflation and that determination on inflation, that bit between the teeth? Where do you stand on that debate?
You love this pivot word today, Tom, right? I think it's a really tough one for the Fed. They're fighting inflation now. They don't want to frighten the market, and that fight versus fright is going to go on, I think, for at least 6 months. I think we do pivot next year. I think we do actually get a cut sometime in 2023. Because I do think the consumer recession that we may well be in right now broadens out to the whole economy as we go into early 2023, and the Fed reacts to that as we get later, maybe into the second half of 23.
How much of that recession risk is priced in to credit at this point?
I think, as say in the US, it's getting there. We could do with seeing that 200 basis point spread for investment grade to feel that actually that risk is fully taken into account. I think in sterling and euro, we're there already. And it feels a lot of recession risks are priced into those markets. But the US market is yet to quite get there. Equities, however, I was reading an excellent report from Business Intelligence on Bloomberg this morning, saying that they are pricing in a recession already and have been since early June. And that may alleviate some of the worst of the kind of spread widening impact as people realize this recession is coming.
Luke, before we let you go, what else do you like in this space? Where's it taking you?
Yeah, I like things where I can see I'm going to get a really nice income from them. I'm afraid AT1 still works for me quite well. Even Credit Suisse this morning, pretty horrible results. But you know what? A 9.1% off their AT1 is an attractive level of yield to get and covers you for a lot of problems on the governance side that you're seeing from Credit Suisse. And we feel the same about Deutsche Bank and Commerzbank and many of the other leading banks across Europe. That's the place I'd rather be, rather than in dividend and equity for these banks. That AT1 space still seems pretty good for me.
Very 9% on Credit Suisse.
9%.
There's the call there. 9%. Wow. Yeah, hard to turn your nose up at that. Luke Hickmore, thank you, Investment Director at Abrdn. Some great insights, of course, from Luke, joining us out of Edinburgh on the credit space within these markets as we lead up to that Fed decision later today. Coming up, Alphabet and Microsoft post double-digit quarterly revenue growth, spurring hope in the sector. We look at the big tech earnings next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Tom McKenzie in London. Let's turn to those big tech earnings then. Alphabet and Microsoft posted double-digit quarterly revenue growth and expressed optimism about the coming months. That may have reassured investors who had been fretting that the tech industry was poised for a dour second half. Joining me now is Matt Bloxham from Bloomberg Intelligence to walk us through what we've seen from the likes of Microsoft and Alphabet and looking ahead, of course, to Meta as well. Matt, what for you stood out from these earnings?
Yeah, I guess really it was just the resilience in a number of dimensions that both of these companies communicated. So I think if you look at Microsoft, very confident that corporates will continue to spend on cloud software, which has obviously been the big driver of Microsoft's growth in the recent years. That essentially, rather than having to spend up front on technology, the kind of flexible nature of cloud software allows them to kind of go up and down with the outlook really. So that I think was encouraging, and that obviously bleeds across to Alphabet, who have an emerging cloud business too. I think the reassurance with Google, though, given that most of its revenue still come from advertising, was they said that brands continue to spend. I think that they've been a little bit they're a bit immune from some of the pressures we're seeing because we heard today that yesterday that Unilever spent $200 million more in advertising in the first half because they're increasing pricing and they need to convince consumers to stick with those more expensive brands, and that kind of brand advertising plays well on Google's
Interesting.
platforms.
So Alphabet has benefited from that,
yes.
even if Snap and Twitter.
Exactly, because the Snap and Twitter platforms certainly Snap tends to be a bit more what we call sales activation, so it's more about that kind of immediate, buy my product right now, whereas the kind of Google platform and to some degree Twitter is more about that kind of software brand advertising. You can feel good about why you're spending 10-15% more on a product compared to what you were last week or so.
And cash flows at Alphabet Still pretty solid, but they've started to come down as well at a time when they're under a bit of pressure to make that cloud business profitable.
Yeah, that's right. I mean, I think this is what the issue they've got is, the cloud business, although it's a lot smaller than Microsoft's or Amazon's, it's still big. It's $26 billion or so annually, but it's loss-making. So I think as the growth on that slows, there's more scrutiny about how do you turn that into a profitable business, not just something that's growing the top line.
What are you looking for as we look ahead to Meta? What's going to be key for them?
Yeah, so the big contrast, I mean, Google grew revenues about 13%, 16% constant currency. For Meta, the market's looking for flat, so a big contrast there.
That's huge. What's behind that difference then?
So a lot of it is this kind of ad tracking change, which Facebook said will cost them about $10 billion of annual revenue. So they're really hurting from that. And also the fact that their platforms are much more about this sales activation type of advertising compared to Google's. And so they're going to get more of a hit from advertisers cutting back on that spend.
OK, it's really interesting. So you have to really break down the advertising picture across these different companies and spending heavily as well, Meta, on some of these alternative products, the metaverse itself. Whether they were running out of time, but just very briefly, are they running short of that?
It's a big pivot for the company. There's a long way to go. There aren't really revenues against that yet. And as you said, heavy investment. So it's a massive bet on the future of the internet.
Matt Bloxham, thank you very much indeed. I put you under pressure on the timing, but you did it and handled it brilliantly as ever. Matt Bloxham, of course, from Bloomberg Intelligence on all things tech. Coming up, Gottstein gone. Credit Suisse replaces its embattled CEO as the lender reports its third straight quarterly loss. Do not miss our interview with Chairman Axel Lehmann. That is next. This is Bloomberg. Gottstein gone. Credit Suisse trade higher after the bank replaces its embattled CEO, despite losses coming more than 7 times forecasts.
Thomas and I came to the conclusion that it is better to have new leadership. We were, as a company, under fire, and he, as a CEO, was under fire. He did a great job, but he decided to step down.
UniCredit shares rally after second quarter profit doubles expectations. The Italian bank upbeat looking ahead despite the political turmoil. And don't forget the Fed. Markets see another 75 basis point hike today. But the question, what comes next, looms ever larger. Treasuries tread water while the dollar dips. Good morning and welcome to Bloomberg Surveillance Early Edition. I'm Tom McKenzie in London. We are checking these markets, of course, as investors weigh up the earnings impact and that look ahead to potentially 75 basis points is really going to be the commentary from Jay Powell and that steer, that guidance from the head of the Fed that is going to be so key to these markets. Across the European benchmark, you're seeing gains of 0.3%, a mixed picture when it comes to banking, when it comes to UniCredit on the upside, Credit Suisse, of course, with all the idiosyncrasies around that business. The DAX is currently unchanged. The CAC Quarante gaining 0.2%. Here in the UK, the FTSE 100 trading at 7,332, 26 points higher for the FTSE 100. Let's switch it over, see how things are playing out then across sectors. One of the standouts is personal care, followed by travel and leisure, but technology as well. You had some positive steer from Microsoft. So the guidance from Microsoft pretty upbeat in terms of its ability to weather the slowdown in growth. We had a reminder from the survey on business, or at least consumer sentiment, coming in much weaker stateside. The consumer picture is also very mixed as well. We're looking ahead as well to what is happening with Meta. You had Alphabet beating on sales. Meta may be a slightly different prospect, as Matt Bloxham from Bloomberg Intelligence was explaining for us just a couple of minutes ago. But banks, of course, front and centre for us today as well on the turmoil out of Credit Suisse. And Credit Suisse has replaced its embattled CEO and said it would embark on a new turnaround plan. This is just 9 months after the last turnaround plan. The Swiss bank indicated it aims to slash the size of its investment bank in the face of mounting losses.
Simplified business, key focus on wealth management, Swiss bank and a multi-specialist asset manager, less complex but highly competitive investment banking capabilities.
Is there at any juncture you can step back from investment banking completely, or is that just not conceivable?
No, we are going to transform and make our investment bank much more competitive, bringing it back to where it has its strengths and, reshape the rest.
Well, where do you think those strengths are going to be?
It will be around a highly competitive banking business. We already have now in IBCM market-leading positions, and it will be a much better aligned markets business around the key needs of our Swiss corporates, retail, and the wealth management clients.
Ulrich Körner, you've worked with him. He's a veteran Swiss banker. Is he really the solution to a bank that needs a radical overhaul, another veteran Swiss banker?
I think he is one of the very few executives in the whole industry that can deliver. Uli has experiences to transform and to build large businesses as well the back end. He knows front to back banking and back to front. I think he's ideally positioned.
To carry the bank forward, you need radical cost reduction and retrenchment. Will those job cuts come from the front of the business? Or, as you say, where Uli is expert, from back to front? Where are the job cuts, downsizing to come from?
We will carefully look to all opportunities. We will, whatever we do, execute with prudence. So we will not just cut and run. I think risk management and risk culture is still at the core, and we want and will go to continue to improve on that one. So we will look to all opportunities. I think it's a major redesign. We got a little bit complex over the past couple of years, and this is what we are going after.
But isn't the issue that risk management just didn't work at Credit Suisse over the past number of years?
Yeah, but we were really fortunate, and I think we gave a great investor update just some weeks ago. We did excellent progress, and we attracted some great talent that drive that transformation.
In terms of you as a chairman, what is your number one message to the board as you sit down after today?
The board is completely unified behind that strategy that we announced today. It's really a refocusing of the strategy, a speeding up, and we will take more radical steps than what we announced in prior announcement, like, for example, last year.
Was Gottstein just not radical enough?
No, Thomas did a great job. Let's not forget, he took over in one of the most challenging periods of Credit Suisse. He put us back to a more stable underlying platform, but now it's time to move on.
Bloomberg's Manus Granny there speaking to Credit Suisse Chairman Axel Lehmann. Let's bring in Manus now for more. He joins us from Zurich. Manus, we can take a step back. You asked that question, was Gottstein not radical enough? How much of a shock is it that he is now gone, or on his way out at least?
I think certainly it came quite fast and furious, is my understanding from the couple of people that I've spoken to over the past 48 hours, 72 hours, Tom, when the chairman went, enough is enough. I've got shareholders on my back. I've got institutions baying for radical change. Gottstein couldn't do it. Yes, he cleared out the board, but he is the last man standing. It is important to contextualise. Gottstein was here under the tenure of Greensill. He was here under Archegos. He sat in that boardroom as he looked at those splendid figures from Archegos. And the board rejoiced when they saw the revenue. This is a bank that needs to rejuvenate confidence. I think it's important that the chairman has made the point we're not going to cut and run. But is that enough? Because the market wants to see something much more radical. Investment banking is slipping down the ladder in terms of importance and in terms of relevance. Having been through a number of strategic reviews in my career, where a variety of people have been encouraged to strategically reconsider the direction of their careers, the question for Credit Suisse is, can you hold on to the rainmakers? What are you going to do to retain the honey money makers across the bank? What do you want that investment bank to be? A much gutted investment bank which feeds the wealth management bank. Doesn't mean that it's not an investment bank at all. It's just a much disemboweled investment bank. Tom?
No honey, no money is our phrase of the day, by the way, thanks to you, Manus Granny. The stock is up 1.6% on the day. The significance, Manus, the significance of these numbers then, because they were particularly bad, and yet the stock is gaining, maybe more because of the executive changes.
Look, I'm not an analyst, but I'd give it to you that the bump in the price is because of the change. This is the window to which Lehmann and Uli Körner have got to jump through. UBS tanked by 10% yesterday. UBS was down 5 billion Swiss francs yesterday. on the back of a terrible performance in asset management and outflows, a miss on investment banking and a miss on wealth management. Look at these numbers, Tom. 7.7 billion outflows, a 1.6 billion loss. We were looking for a loss of 220 million Swiss francs. This is going to take more than just the plain vanilla comprehensive review. This is going to take something pretty deep, pretty meaningful and radical shake-up and a redefinition of who you are and what you want to be. And I put it to you, Tom, this bank is more exposed than it's ever been before to a bid. The Americans come. They love Zurich in the summer. I just wonder, is Jamie's jet ready to hit the tarmac?
Very, very interesting. Is this one that may be snapped up by one of their US competitors? What do we know about that CEO, the new CEO taking over, and that ability to push through these changes that are needed, Manus?
There's no doubt about it. He is a veteran banker. He's worked at UBS. He knows the chairman quite well. So he has a 20-year career behind him at both major institutions. Tick. Culturally, Swiss. Tick. We know there's been huge issues about new personalities and people of different backgrounds coming into businesses. And that has been an issue. That has been an issue across a number of companies. But he's a veteran. He knows the chairman, so he's going to have absolute support. And maybe that's what this CEO gets. He's untarnished. He's untouched in terms of scandal. And therefore, Tom, maybe he has more liberty to say to a new board, this is the plan, this is what we're doing, and this is the way we're executing it.
Bloomberg's Manus Cranny in Zurich on that Credit Suisse story. We're going to watch the private jet of Jamie Dimon to see, you know, if it's making any diversions towards Switzerland. We'll check the jet. Thank you, Manus, as ever. Fantastic reporting, of course, on the ground for us out of Zurich. Continuing with the banking theme, Deutsche Bank has warned it will miss a cost target for the year and said a key profitability goal was getting harder to reach. That's as the war in Ukraine, surging inflation and litigation costs drive up expenses. The CFO, James von Moltke, spoke with Bloomberg's Anna Edwards from Frankfurt.
There's no reason to think the trends from the first half won't repeat in the second. That said, you know, the market needs a direction, and that hasn't been as present in the late June, early July period as the rest of the year. I think the markets are awaiting sort of the next set of central bank actions, including today from the Fed, and then we'll see how the tone develops from here.
Deutsche Bank CFO James von Moltke speaking to Bloomberg's Anna Edwards. Joined now by Andrew Stimpson, who is the head of European Banks Research at Keefe, Bruyette and Woods. Andrew, fantastic to get you on and your insights, of course, after what looks like a mixed picture across the banking earnings picture, whether it's UniCredit on one end, Credit Suisse on the other, Deutsche Bank, of course, within the middle somewhere. What is your take of where things stand in terms of this earnings picture? And then we can drill down into Credit Suisse.
Yeah, it's been overall a very good earnings season so far for the top line, certainly for net interest income for all the banks which have reported so far. It's generally been very, very strong. There's obviously some headwinds for most banks around capital, not for Deutsche Bank. They bucked the trend with capital actually improving this quarter. And I suppose for investors, the most interesting thing or bizarre thing is that almost every bank is out there telling us that there are absolutely no problems on asset quality, which is just completely different to the concerns that almost all investors have, which is fears of recession and a credit cycle for the European banks.
Is it your assessment that that asset quality holds up within a slower growth, a recessionary environment, Andrew?
The jury's certainly out at the moment. The feedback from the banks is very consistent. There's lots and lots of reasons to expect that credit quality this cycle will be more representative of a recession and not a crisis. So we find sometimes people want to use the word crisis and recession interchangeably, which we really disagree with. The underwriting standards that the banks have got this time around are much stronger than what they were 10, 15 years ago. That's partly because of the work that the regulators have done to shore up underwriting standards. Capital levels are a lot better, other things, but nevertheless, these are cyclical businesses. So there are lots of reasons to expect, for me to argue that actually the credit cycle won't be as bad and it won't reach anything that resembles a crisis. But nevertheless, that is the jury's out, and we've got to kind of prove that negative, if you like, that there isn't going to be something much worse on the horizon.
OK, that distinction between a recession and a crisis. There is a crisis, though, at Credit Suisse, and they have had, of course, this change at the top. What do you make of that ability for the new CEO to finally get a grip on this lender? And is it indeed potentially an acquisition target at this point? It's
definitely an enormous job that the new CEO and the new management team will face. The idea and the concept behind the plan to pivot more towards the higher profitability wealth management businesses is very valid, and that makes a lot of sense to, I think, everyone in the market. The problem is that we've been here before, and lots of businesses, in particular Credit Suisse, as you said earlier, Tom, it's only 9 months since the last plan. This has been tried before. The end point of the plan is often very valid. It's the journey to get there, which is often really quite difficult. And we've seen multiple European investment banks try and restructure over the past, 10, 12 years. And it's always a really, really tricky journey. And some of them managed to turn things around. I think Deutsche Bank's a good example of that more recently, where, the troubles that Deutsche Bank had many years ago, it's starting to move through those and actually producing much better results now.
Yeah, whether Credit Suisse can learn a lesson from Deutsche Bank as well. Andrew Stimpson, Head of European Banks Research at Keefe, Bruyette & Woods, with that insight. Thank you very much indeed. And of course, on the asset quality that still holds up across these European lenders. The question is, for how long? Coming up, we're going to be talking about gas. Of course, prices elevated once again. And just checking on the Dutch gas prices, up 7%, of course, after a couple of days of double-digit gains. The concerns about a reduction of flows ever nearer from Russia. Stay with us. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Tom Mackenzie in London. Now, European gas prices have soared on supply fears, with the Kremlin likely to keep flows at minimal levels as the war in Ukraine drags on. For more on this, let's talk to Bloomberg's Rachel Morrison in London. Rachel, Nord Stream gas flows then, they've fallen to about 20% capacity. How do we know? How long is this likely to last? Do we have any sense, or do you need to be the mind reader of Vladimir Putin to get a real accurate gauge on how long this goes on for?
That really is the key question, how long flows are going to be reduced for and what the levels will be. So we know from insiders that it's likely, as you mentioned, that flows will remain reduced. And it sounds as though from what analysts are saying that we really need a bit more than 20% to ensure that storage levels get filled in Europe in time for winter. So you can see the prices have been so volatile that that's really showing us that even though President Putin did mention this supply cut last week, that nobody really knew whether it would happen or to what degree. So at this point, we've only got one turbine functioning on Nord Stream. So if something happens to that one, if it also needs maintenance unexpectedly, then flows would be cut. But equally, there is a turbine coming from Canada to Germany and then to Russia that's supposed to replace this one, which should mean that it can continue. And you have to weigh up the two things. On one hand, Russia needs somewhere to send the gas. It does need a customer in order to continue to get the revenue from the high gas prices. But at the same time, it's really a political tool and a political weapon that Putin, it seems, is using to try to splinter European solidarity.
So that's the test then, the next turbine, whether it arrives, whether it's put in place and whether it increases flows on the back of that. Price is currently up 7.8%. They've been up elevated every day of this week. In terms of that focus from European ministers to reduce reliance and cut back by 15%, yes, it's still voluntary, but how effective is that likely to be?
Yes, what we saw yesterday was voluntary, and then if the situation deteriorates, it can become mandatory. There were a lot of exceptions that watered down this agreement. So certain countries will have less obligation to do this. So really, I think overall the interpretation of the 15% is that voluntarily it won't make that much difference, and if the situation gets bad, then we will see mandated rationing, and it will be at a national level. So that will be factories, industries being told that they must shut off at certain times.
Potentially edging ever closer to mandatory reductions in gas use. Rachel Morrison, thank you for breaking down the latest story for us on those reduced gas flows from Russia. Coming up, Mercedes raised its outlook for the year, expecting more new models. We'll keep it racing to shore up that demand. More from our interview with the CEO next. This is Bloomberg.
We're watching inflation. We are, of course, watching central banks' reaction to that inflation with interest hikes. So it's something that we have to be mindful about. So far, we have not seen any reduction in demand for Mercedes. So demand for us currently is strong, but it's something that you have to have in mind and see how things develop into next year.
OK, that was Mercedes-Benz CEO Ola Källenius speaking earlier to Bloomberg's Yusuf Gamal-Adin about their results. Talking of which, earnings season, of course, well underway. So let's get an update then on the beats, the misses and the future outlook. Also in focus, of course, is the impact of the dollar and the strong dollar on corporate earnings. Joining us from Singapore is Tim Craighead from Bloomberg Intelligence, who's been working through all the numbers for us. Tim, with more than a quarter of the European market having reported then, what is the scorecard looking like?
Yeah, as we pulled stuff in through this morning, we're seeing a pretty interesting earnings picture emerge that's quite unusual. On the one hand, top line is doing better than expected. We're talking upwards of 60% of the companies are beating expectation. However, on the bottom line, we're seeing roughly half of the companies miss expectation. And this divergence is it's not surprising in a way, but it's highly unusual. We're now seeing top-line growth at about 22%. Earnings are tracking somewhere 13–14%. So there is definitely a divergence, and there's definitely negative operating leverage playing through here, which is a worry.
OK, so some pretty acute divergence then in terms of those numbers and the earnings versus the top line. Where does that leave us as you assess the outlook then for the end of the year?
Yeah, look, we've seen valuation compression in the first half of the year with rising interest rates. We think the baton is now being passed with valuation probably as low as roughly as it's going to go, but earnings now take the lead. And with a sloppy second half ahead with this sort of a divergence, potential for negative operating leverage, operating margin contraction relative to what are still inflated expectations, we think it's a sloppy second half of the year, and that's going to continue to be bumpy. We don't think we're at a bottom at this point quite yet.
Tim Craighead with the earnings scorecard, a sloppy second half coming up. Tim Craighead, thank you very much from Bloomberg Intelligence. Your markets here in Europe, you're looking at gains of 0.4%. Bloomberg Surveillance Early Edition continues in the next hour with Matt Miller, Kailey Leinz and Anna Edwards. This is Bloomberg.
We've seen this movie before. It's very tough to put inflation back in the bottle and cut expectations.
The consumer is not as resilient as they've been in the past.
For most people, it looks and feels like a recession. You've also got this fact that the world is changing.
We're in this kind of very weird kind of backdrop where there's a lot of bearishness.
Whenever the Fed is in either a hike cycle or even if it's accommodating, the general thought is that the Fed will fail.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kailey Leinz.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. Waiting for the Fed to make its move, investors are counting on another 75 basis point increase. They also want to hear what Fed Chair Jerome Powell has to say about what's next. Another change at the top. Credit Suisse replaces its CEO again. Thomas Gottstein is gone after 2 years of scandal and big losses. Meanwhile, inflation headwinds may keep Deutsche Bank from its targets. And a reason for hope, Alphabet and Microsoft show that big tech can handle a slowing economy. The market looks for more evidence today when Facebook owner Meta reports. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London, Matt Miller and Kailey Leinz with me in New York. And guys, just so much to deal with today in terms of the European earnings flow, the tech news we've had overnight, the Fed, of course, in focus for us later on. Some of the conclusions coming through from the European earnings story so far seems to be we're getting beats on the top line, this according to Bloomberg Intelligence, but misses on the bottom line. And that's making for a quite complicated interpretation of the earnings story.
Yeah, and of course, we're going to get more earnings here in the U.S. after the bell today. Meta will be reporting how much do they follow Snap or how much do they follow Google. And that search advertising revenue seems to be doing okay. We saw that evidenced by Alphabet's earnings yesterday. But of course, Snap and Twitter disappointed last week. So it'll be interesting to see where Meta or Facebook in particular falls. But of course, that may be overshadowed a bit, Matt, by the Fed decision we're getting at 2 p.m. Eastern time. 75 basis points is the move expected.
Yeah, absolutely. And I mean, the important thing, I think, with the Fed decision isn't really what we get, because we all are expecting 75 basis points, but whether or not they decide to trash forward guidance. If they get rid of it, then you have to fall back on your natural views. Are you a bear or are you a bull? If you're a bear, then maybe you think it's time to buy bonds. If you're a bull, then maybe you think it's time to buy stocks, because the question is, without forward guidance, does that mean the Fed peaks now and cuts later, or does that mean it gives them an open road ahead to continue raising rates?
Yeah, I guess we'll look for the color out of Jerome Powell at the press conference to see if he sticks to the inflation-fighting language versus anything expressing concern about the health of the U.S. economy. So, of course, that's one thing we'll be watching today, but there's plenty more in the day ahead, including the EIA issuing its crude oil inventory report at 10:30 a.m. New York time. Then at 11 a.m., Spirit Airlines shareholders are scheduled to vote on its proposed merger with Frontier. Of course, that's been delayed a number of times. Then Ford, Matt Miller, will be reporting earnings at 4 p.m. Eastern time. The tech earnings will continue with Meta and Qualcomm reporting after the bell. But, of course, today's main event is that Fed decision at 2 p.m. New York time. Many Fed officials have come out in support of another 75 basis point hike, but could 100 basis points be on the table? Michael McKee, Bloomberg International Economics and Policy Correspondent, joins us now from our D.C. bureau. Mike, 100 basis points, are we likely to see it?
Not likely to see it. There's been no leak from the Fed, as there was last time, that suggests they're going to go higher. But at this point, it's all about the data, as Matt was saying, and the fundamental view that you have. I'll put it in a way that Matt might like. This is 3 days of a Wall Street Woodstock, peace, love, and economic data, all about 2 lines on a chart. Inflation, which we get on Friday, going down maybe, but maybe it prints higher. And then growth. We had first quarter GDP negative. Now, what does the Fed do as we approach tomorrow's report on GDP? Well, they don't know. They have the unfortunate problem of being the warm-up act for this week. They've got to go first. So Jay Powell is expected to announce that they will raise rates 75 basis points. That's kind of baked in. They don't want to disappoint the markets. But then comes the question, as Matt said, of forward guidance. What do they tell us about what they do next? And that's going to be a real issue for them, because they don't want to get locked in. If growth is falling, maybe they want to dial back. If inflation is rising, maybe they want to do 75 again, or even consider that 100 basis points. So don't expect a lot of guidance from them, but do look to the statement and Powell's news conference for what they say about growth and inflation and how they see both going forward.
Yeah, you don't want to tie your hands behind your back, and you don't want to repress the market as a signal in terms of what's going on at the economy. Michael McKee, thanks so much for joining us, reporting live from Washington, D.C. Our special coverage of the Fed decision starts at 1:30 p.m. New York time, 6:30 p.m. in London. But, of course, we'll be talking about the Fed all day long and probably continue for every day for the rest of our existence. Now, Credit Suisse has replaced its embattled CEO and says it will embark on a new turnaround plan just 9 months after the last one. Bloomberg's Manus Cranny spoke with the chairman, Axel Lehmann, in Zurich earlier.
Thomas and I came to the conclusion that it is better to have new leadership. We were, as a company, under fire, and he, as a CEO, was under fire. He did a great job, but he decided to step down.
Manus Craney joins us now from Zurich, and of course, Thomas he's referring to is Thomas Gottstein. He's out of there and will be replaced, Manus.
He's gone for health reasons, or was it just one loss too many that finally caused a moment of capitulation for the chairman, for the institutional shareholders, which were the driving force behind this change? Lehman, the chairman, spoke to me this morning. He said it was an institution under fire, a CEO under fire. I put it to you, Matt and Kailey, this is an institution under siege. The shake-up that they need to deliver will be something radical at the investment bank. The chairman says it's not a cut and run. I've been covering these banks for 12 years now with Bloomberg. I've watched Joe Motti gut the investment bank, disembowel and disempower the investment bank in the first flush. Is that what is to come here at Credit Suisse? It's a capital-light model of the investment bank, and it is to feed the wealth management and the Swiss business. That is the priority. They're going to speed up the transformation. No capital raising, no cut and run. Those were the top-line messages from the chairman. I put it also out there on the table. Track Jamie Dimon's jet, because this is a bank which is now a price-to-book value, which looks salivatingly tempting to an overseas buyer with a strong Yankee dollar.
Could we soon be talking about M&A in banking? Manus, thanks very much. Bloomberg's Manus Craney reporting there from Zurich. On to other European bank news, and we got some details from Deutsche Bank this morning. The German lender warns it will miss a cost target for the year and says a key profitability goal was getting harder to reach. I spoke with the CFO, James van Moltke, earlier.
There's no reason to think the trends from the first half won't repeat in the second. That said, the market needs a direction, and that hasn't been as present in the late June, early July period as the rest of the year. I think the markets are awaiting sort of the next set of central bank actions, including today from the Fed, and then we'll see how the tone develops from here.
He was talking positively there then, Matt, about the direction of the FIC business and the performance of the FIC business, fixed income, and when you look back, did look pretty decent, standing up against the US competition. Of course, we went on in the conversation to talk about the German economy and the risks to it, and he's clearly concerned about that.
Yeah, well, but costs are the main problem for Deutsche Bank or any of these European zombie banks, right? They have to keep costs low because they are zombies. And if they don't, it's going to be a problem for investors. This is definitely not looking good for Deutsche Bank or for Credit Suisse.
Right, and on the subject of costs, they stepped away from one of their cost targets, and that is something that the market has put them under scrutiny for. Matt, let's turn our attention to big tech then today, and Alphabet and Microsoft both posted double-digit quarter revenue growth and expressed optimism about the coming months. In an interview with Bloomberg's Emily Chang, Alphabet CFO Ruth Porat said data on the macroeconomic environment, quote, remains complicated. At the same time, she said Google was, quote, very pleased with its performance in search. Joining us now for more is Kriti Gupta, Bloomberg's markets correspondent. And Kriti, NASDAQ futures expressing the optimism that we saw after hours from these two businesses.
Well, this was the big concern, Anna, the idea that if tech can't hold up, what really can, given just the massive cash profile it has, given the kind of security and supply chains it has as well. And nevertheless, it did not disappoint. What's crucial about Alphabet here is that one of the concerns was those social media kind of advertising pullback, and you already saw that in Snapchat and Twitter last week, and it's not something that Google, or I should say Alphabet, was really exempt from. You did see this in their YouTube business. Ad results, or ad sales I should say, did actually pull back quite significantly, but ultimately, to Ruth Porat's point, it was the search results that kind of rescued the company. And remember, Alphabet also has a cloud business that's getting larger and larger, so that actually helped their bottom line as well. Microsoft, on the other hand, once again, it's all about business investment there, and for them, it was their Azure cloud business that actually grew. And remember, we are still in this massive cloud transition where you do have lots of business dollars being put towards that. Nevertheless, one of the big, I want to say, weaknesses or Achilles heels for Microsoft was that dollar story. If you start to see a reversal in the dollar, that's where Microsoft was really poised to benefit.
Yeah, those FX headwinds very real for a lot of these big multinational companies, and I expect we'll hear more about that from the rest of the tech companies reporting this week. But as you talk about how the strength for Alphabet came from search, that doesn't seem to me like it has a very positive read-through for Meta, because that is all social media advertising.
Yeah, it absolutely doesn't. And that's where on the spectrum of tech and what's the most perhaps stable, quote unquote, stable tech, like your Apples, your Microsofts, your bigger tech, even Alphabet, which is a little bit more diversified. Well, Meta's on the other side of the spectrum. It's closer to Snapchat. It's closer to Twitter. So one of the concerns here is that if Alphabet and Microsoft were these kind of macro proxies to some extent, Meta necessarily isn't. In that way, you might see that ad slowdown show up similarly to what you saw on Snapchat and Twitter last week.
All right, Kriti, thanks very much for that. Kriti Gupta covering, as always, the big FX effects on earnings for us. Now, President Biden is set to speak with President Xi Jinping of China on Thursday, and the call comes amid fresh tensions over Taiwan and the possibility of a visit by House Speaker Nancy Pelosi. Bloomberg's Anne-Marie Horton joins us now out of Washington. So, Anne-Marie, I guess the Pelosi visit will be something that they have to discuss.
Right. Well, this is top of mind for Beijing. They've been vehemently opposed to this visit, potential visit, we should say. There's no firm plans yet from the speaker to visit Taiwan. But this call, which we should note, the president has been foreshadowing, but Bloomberg first to report the date of this would be this week. And given the fact that China is so against this potential visit by Speaker Pelosi, we just heard about an hour or so from Kyoto News that she is planning preparations to visit Japan in August. So she is going to be making this Asia trip. We're still waiting to know about the Taiwan piece. But the president said pretty directly to reporters recently that the military does not think this is a good idea right now. Of course, the other big agenda piece that Beijing is very keen to learn about, as we are as well, is whether or not the Biden administration is going to lift some of those Trump-era tariffs on billions of dollars worth of goods. So I think Taiwan and tariffs will really be in focus as these two leaders speak, and they haven't spoken to each other since March.
All right, Anne-Marie Horton, Bloomberg Washington correspondent, thank you so much. Now, we do want to get a look at the markets now ahead of the Federal Reserve decision. You do have futures higher here in the U.S. by about 1%. Yields moving lower, though, interestingly. We're at 277 on the 10-year Treasury yield. But beneath the surface of the equity market, there are a number of big movers because, of course, it is earnings season. One of them being Enphase. This is a big U.S.-based solar energy company, but it actually saw revenue in Europe up 69% in the quarter it just reported. Of course, because European energy costs are moving higher. That a big boon for companies like this one. It's up about 10% before the bell. You have other stocks moving higher as well, including PayPal. This is actually after reports overnight that Elliott Investment Management, the activist investor, is taking a stake in the company, really trying to accelerate its cost-cutting efforts. As a result, that stock is up about 6%. And I just wanted to check on Coinbase as well, because yesterday was a really, really bad, no good, awful day for Coinbase, down 21% on reports that the SEC is investigating the company as to whether it listed digital assets that should have been securities. Big, messy regulatory situation that took the stock down hard, and actually saw Cathie Wood's ARK Investment Management selling Coinbase shares for the first time this year. But it looks like some people are at least buying some of that dip this morning. The stock up about 5.8% before the bell, but keep in mind it's down more than 77% year to date, Anna.
Kailey, coming up, we will talk to Jordan Rochester, G10 FX Strategist at Nomura. Strong dollar, one of the themes, of course, we'll get to as we wait for the Fed. Weakness in the euro yesterday, under pressure from higher gas prices. All of that very topical. We'll get to Jordan with a focus on FX. And Ukraine is struggling to rebuild its economy while still at war with Russia, of course, churning out vodka and steel under the continued threat of bombardments. Read more in today's Big Take story, Bloomberg.com, or by typing NI Big Take into your Bloomberg terminal. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kailey Leinz over in New York. Let's take a check of the markets here in Europe. And European equities making some gains today. We've got earnings to process, plenty of earnings to process. And we, of course, look ahead to the Fed. The Stock 600 then up by 0.4%. We are, of course, still focused on what's going on with gas. And this in the face of this ever-tightening situation for the European gas story. So natural gas, the futures picture there, the benchmark futures up by another 9%. Just for context, we're up at, 217 euros a megawatt hour. We were down in a range of 13 to 17 pre the pandemic. So that's what the kind of numbers that were normal back then. A lot has changed since. Credit Suisse down by just 0.5%. The market watching and waiting perhaps what the new CEO brings, what the new strategic review will bring. A huge loss from Credit Suisse and a change at the top, of course. And Adidas in there as well, down by 5.2%, Matt, as the maker of sportswear over in Germany puts out a profit warning. They're having trouble in China because of lockdowns, but also because of boycotts around their products. So China, not a big headwind for some of the big luxury names, but certainly for Adidas, it has been an issue.
All right, we'll pay attention to that. Of course, it's the Microsoft story, I think, that has markets really charged today to the upside. Dan Ives from Wedbush saying that their forecast increase was the forecast heard around the world. So as a result, we have S&P futures that are rising. There was so much concern, as Critty was telling us, around FX, but there is such a rosy forecast for 2023 that traders are willing to look past the past and bet on the future. The U.S. 10-year yield coming down just about 2.5 basis points right now at 278.13 as investors buy that debt. The question is what's going to happen this afternoon, obviously, with the Fed. Not only the increase, will they raise 75 basis points or 100, but will they abandon forward guidance? And then what does that mean for markets going forward? NYMEX crude not doing much, up about 73 cents a barrel and 95.71 right now. And Bitcoin up 1.6% to 21,320. Let's bring in Lynn Thomason, Bloomberg Markets editor, to talk about more about what the Microsoft earnings forecast means for this market. I mean, I guess the QQQs were being bought heavily yesterday. That's the tech ETF, and now we see futures up strong. So is this all about Microsoft's forecast?
Yeah, absolutely. I mean, I think as we spoke to one investor today, called it, markets are breathing a sigh of relief after getting those earnings from Microsoft, and well as Tech's instruments. You get the sense that, the big tech giants, possibly doing okay, and perhaps, we'll see a market of, haves and have-nots, of the weaker ones getting hit, like Snapchat and Microsoft and Alphabet doing okay.
And I thought today was busy, Lynn. You just shocked me. But I read that tomorrow is busier. Yes,
tomorrow is the big Super Thursday coming out. We've got, I think, over 80 companies in the Stock 600 reporting.
It's a $9.4 trillion results day.
Yes, and I think, investors will really be looking for what are companies saying about earnings, how are things holding up. I mean, any context about inflation is really going to be in focus.
Well, on the subject of inflation, we'll also be getting some insight into how the Federal Reserve is thinking about it when we get that decision later on today, Lynn. We understand the move is likely to be 75 basis points. They've essentially told us that. So where could the surprises be?
I think the surprise is what's going to happen next. Everyone seems very certain on what's happening now, but then as you look forward, the situation gets a lot hazier. Will the Fed, be continuing to want to hike in an environment where the economy is really starting to slow? So I think, from what we've heard from people is that, the 75 basis points is baked in, but, it's anyone's guess as to what happens next.
And whether we get them, whether they express any satisfaction or dissatisfaction with the way the market is priced at the moment, however they choose to do that. But there is this expectation that we get a pivot, and it's being expressed by forecasts and market pricing around cuts in interest rates next year, and the Fed might not like to see that quite so soon.
Yeah, I mean, whether the Fed is going to really start easing in this environment is the big question, or whether they'll stay put. I mean, I think there's a strong argument, perhaps, staying neutral for a little bit, especially if growth starts to ease. And I think the other thing that we're hearing from investors is that, any kind of suggestion about a recession coming will really be in focus.
Okay, plenty of data still to come in the days ahead as well. Mike McKee talking about a Wall Street Woodstock of data over the next coming days. Lynn, thanks so much. Lynn Thomason joining us there. For more market analysis, check out MLIV Go. That's the function to use on your terminal for the Markets Live blog. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Matt Miller in New York and Anna Edwards in London. Now keeping you up to date with news from around the world, here's the first word. For the second night in a row, the two conservative candidates to succeed Prime Minister Boris Johnson battled it out in a televised debate. Foreign Secretary Liz Truss and former Chancellor Rishi Sunak clashed again over the economy. Both accused each other of pursuing policies that are morally wrong. The debate was cut short when the moderator fainted, but the debate organizer says she is now fine. Bloomberg's learned that the Justice Department is using a grand jury to investigate efforts by former President Trump and his aides to overturn the election. The focus is on creating fake electors and pressuring former Vice President Mike Pence to refuse to certify the Biden victory. No comment yet from the Trump camp. The first Chinese city to impose a COVID lockdown has now imposed another one. Wuhan has locked down a district of almost 1 million people on the outskirts of the city after 4 cases were found. People have been told to stay in their homes and public transportation has been stopped. And grain exports from Ukraine could resume within a week and reach 25 million tons by the end of the year. That's according to Turkey, which brokered a deal between Ukraine and Russia that eased fears of a global food crisis. The United Nations expects the first ship could leave a Ukrainian port in a few days. And of course, that could ease up pressure on food inflation. We've seen commodity prices come down, which has a cooling effect on inflation as well. What does it all mean for the Federal Reserve as they gear up for another 75 basis point hike today? We'll discuss with Jordan Rochester of Nomura next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Waiting for the Fed to make its move. Investors are counting on another 75 basis point increase. They also want to hear what the Fed Chair Jerome Powell has to say about what's next. A change at the top again. Credit Suisse replaces its CEO again. Thomas Gottstein is gone after 2 years of scandal and big losses. Meanwhile, inflation headwinds may keep Deutsche Bank from its targets. And a reason for hope. Alphabet and Microsoft show that big tech can handle a slowing economy. The market looks for more evidence today when Facebook owner Meta reports. I'm Anna Edwards in London with Matt Miller and Kailey Leinz in New York. And as you said earlier, Matt, it seems to be, the European session trading on some of the earnings reports we have here. But in terms of US futures, you just have to look at NASDAQ futures and the S&P to some degree to see big tech pricing in better expectations.
Yeah, absolutely. We're not worried here about Thomas Gottstein, but more about Microsoft and Google. And there was a sigh of relief when you heard Google's forecast, and Microsoft was even kind of hitting it out of the park. So that's why we have U.S. futures up 1 full % here. Investors are pretty positive about tech stocks, and we have a lot of them. Of course, European markets don't have a very heavy tech bias. On the 10-year yield, which we'll be watching very closely today, and especially at the shorter end of the curve, watching that very closely because the Fed comes out with most likely a 75 basis point hike. There are some people who think the Fed should raise rates by 100 basis points, but what's the Fed really going to do, right? 278.67 is the yield on the 10-year right now. The NYMEX crude trading up 72 cents a barrel to 95.68. It's been kind of a hot and cold market here, a lot of volatility in oil, so it's up and it's down, it's in and it's out. I don't remember the rest of the Katy Perry song, but you get it. And then Bitcoin right now up 1.5% to 21,313. It's looking pretty weak, frankly, even though it's up from 5 o'clock yesterday because we had pushed all the way up through 23,000 and now we've come back down. Kailey, what do you see in terms of pre-market movers?
Well, now I'm just singing Katy Perry in my head. I think it's hot and cold, yes and no. In and out, up and down. I think that's the series in the song. In pre-market trading, of course, as you and Aaron were talking about, it is all about those large cap technology stocks after better than expected results from Microsoft and Alphabet after the bell. What I think is so interesting, when you look at Microsoft, you actually did see those FX headwinds showing up. The quarter disappointing. There was some softness in cloud computing and software demand. Yet that outlook was really, really rosy. Dan Ives over at Wedbush calling it shockingly strong, and that is what is lifting the stock up 3.6% before the bell. And then, of course, Alphabet search revenue holding in a lot higher than expectations were given the softness Snap and Twitter had seen. So it really speaks to the divergence between search advertising and social media advertising. So will we see that reflected when Meta reports after the bell today? Right now, that stock up 2.7% before the bell. And then, of course, Amazon will be coming tomorrow after the bell. Anna, it was down 5% yesterday after the forecast cut from Walmart really weighed on retailers, but a little bit of a rebound this morning with the stock up more than 2% before the bell.
Kailey, I'm still just blown away by the extensive team knowledge of Katy Perry lyrics and how useful they are in describing the markets. Kailey, on the US markets there, let's have a look at what's going on in European stocks right now. And Stocks Europe 600 up by 0.4%. We've had a mixed picture really coming through from all the earnings. There's so much going on in terms of the European earnings story and a lot more to come in the next 24 hours. One thing that weighs on expectations around Europe is certainly the higher gas price, and that continues yet again. It's been the story of the last couple of days, and it continues to be so, up another 8.5% in today's session. Credit Suisse, the bank over in Zurich that just can't catch a break. It keeps running into issues. It keeps getting itself stuck into sticky areas of the market. And we've seen them replace their CEO yet again, announce another strategic review. We'll see where this one ends up. Adidas, the sportswear manufacturer, then that stock down by 5.4%. Kailey, we saw in the LVMH numbers that they were pretty robust in the face of difficulties in China. More of a global story that was benefiting them there. Adidas, on the other hand, they ran into difficulties in China, and it was the lockdowns plus boycotts by certain consumers that made life tricky for that business.
Yeah, all right, Anna. So there's definitely a lot of individual company stories to keep track of on the micro level, but at the macro level, it's going to be all about that Federal Reserve rate decision at 2 p.m. Eastern time. It is widely expected that they will move 75 basis points. But Nomura has a bit of a different opinion. Jordan Rochester, G10 FX Strategist from Nomura, is joining us now with more. You think the move will be 100. Why?
Well, indeed. Well, look, if I was to think about it, Katie, if we're keeping it to Katy Perry lyrics, hot and cold, well, this should be more like a firework when it comes to the Fed. The sort of fact is we've had inflation surprise after inflation surprise in the US. You look at the break-even curve in the market, it says inflation is just going to collapse in the US. Now, that's just not happening, the actual data. So the market's had a bias to say, well, look, this is peak inflation for the past few months. But I think what the Fed should be looking at is that mortgage rates have started to soften. We're seeing financial conditions easing because the markets are pricing in Fed cuts next year. That's great. That fits with what our view is. We expect 100 basis points tonight, but we do expect rate cuts next year. But the inflation credibility, the inflation targeting and credibility of the Fed, they need to boost it. They need to give the market a bit of cold turkey, or in Japan, a bit of cold sashimi, as we'd say. They need to do 100 basis points to say, look, we are credible. And like the ECB, they need to actually surprise markets. What I'm quite tired of is whatever's priced for a Fed meeting is what they deliver. And that's just leading to the same path we're on now, which is inflation is essentially saying you're behind the curve. And I think the markets need to have a little bit of a shock. And that will boost the dollar, and that will help the Fed achieve their inflation credibility once again.
I know that they do, in some senses, want to surprise because they want us to be surprised by the intensity, the laser focus that they have on inflation. But do we really want the Fed to start surprising markets left, right, and centre, Jordan? I mean, isn't the point of giving a lot of guidance to the market? Isn't the point of that to reduce the volatility? And we've all seen plenty of that recently.
Indeed, I think the Fed's standing out now as one of the few central banks that still gives forward guidance via their Federal Reserve members coming out and tell us what they individually will vote for. Kind of gives us that guidance. We look at what Bullard will say, and he's kind of the activist on the panel. But let's look at the ECB. Let's look at the Bank of England. They have ditched forward guidance. That's what the surprise was from the ECB last week. I think we've become very used to having forward guidance when rates were at zero, we're at the zero lower bound, and it was about pushing down long-term yields to try and achieve their inflation goals. Now that we're talking about rate hikes, with the data being so uncertain, the potential for gas rationing in Europe, the potential for supply chains to be worse globally, I think the Fed could join the ECB and the Bank of England eventually by perhaps giving us less forward guidance or more uncertainty. I find it very interesting. After that CPI number the other week, we did see 100 basis points priced in for the Fed very temporarily, only to then be knocked down lower towards 75 when a few Fed members, only a few as well, gave us their view. So there is still uncertainty around this decision tonight. What I'm saying is the risk reward is it's either 75 or 100. So that's kind of why we're still looking for Eurodollar to head lower towards 95 by the end of August into September.
And it does look like at some point they're going to ditch forward guidance. Kevin Muir from the Macro Tourist says central bankers tend to be like teenagers in a mall. They move in packs. If they do get rid of that, then what do you expect, Jordan? What's your forecast for risk assets if the Fed ditches forward guidance?
I think it's going to be a very tough winter for risk assets. We've just got this situation in Europe that's going to have a global impact. There's also the property sector in China slowing down. And then in the US, the rates move we have had is slowing down the housing market, and that will have knock-on effects for the consumer. Consumption will fall to near record lows. We're having consumer confidence lower than the Lehman Brothers moment in 2008. So there is a growth story that makes us say, look, central banks need to raise rates now. They need to be aggressive, need to regain that credibility, because there could be a wage price spiral if they don't. But then next year, we think they will have that credibility. Inflation will then slow down. And then we're talking about rate cuts. So we're looking for the Bank of England to start cutting rates in May, ECB in June, Fed in July next year.
Okay, yeah, and we'll see if we get any pushback against those expectations of rate cuts from the Fed today. Moving away from the Fed to think about the euro, Jordan, you were talking a lot about the things that weigh on expectations for the eurozone economy. One hedge fund yesterday came out with a forecast for the euro that was 80 US cents. What are you expecting to see for the euro? How weak could it get?
Indeed, I saw the same headline and I shared it internally here at Nomura. And why? Because, well, the hedge fund said, I think, 80 cents. And if I look at the framework I've been using to kind of get a yardstick as to where euro should go, look at terms of trade, for example, it points to a historical relationship. It's quite good for telling you sort of fair value for the euro. It actually says 65 cents. So 80 is not even that extreme. 65 is where one model says it should go. But look, the market is a balancing act. Just one model output isn't actually going to be where euro goes. We're looking for 95 by the end of August. It could get to 90 cents if Germany doesn't build up enough gas storage. So if Germany does introduce phase 3 of its gas plan, it leads to German GDP being severely hit. The Bundesbank estimates 5 to 8% by Q1 of next year. 5 to 8%. It's one of the biggest economic shocks outside of COVID. That's a significant problem for the Eurozone. German industry will be forced to ration its gas. That will increase imports. The Europeans will need to get parts of their supply chain from elsewhere. That will weigh on the Euro's trade balance. So again, that erodes the value of the euro. Its sort of terms of trade will get worse in that scenario. So that's why I think we shouldn't be hyperbolic when we say it could go to 90. It's very possible.
Speaking of terms of trade getting worse, the IMF says that the UK will have the slowest growth in the G7 next year. When do we start seriously discussing parity for the pound?
Same model, terms of trade already says we should be below parity in cable. That's not the call we have, just because I think by the time we start to get towards 115, we're looking for cable to get to 115, down towards 110. I think by the time we get there, global growth expectations might find a way to rebound, which would be perhaps we get through the worst of winter, or perhaps China does a big fiscal stimulus, or the EU acts jointly and does a big fiscal stimulus, or the Fed does a dovish pivot. So that's by the time we get down to 115 towards 110 in cable, then maybe the Fed starts to slow down its rate hikes, and then the dollar can soften. But that terms of trade already tells you that if that model's right, cable could be below parity. So one model, one output, it's not my core view, but the direction of travel is very clear.
Okay, Jordan, thanks very much. If we get to parity, then Matt Miller's paying for my next trip to the US. Thank you very much. Nomura's Jordan Rochester joining us here to talk about FX. Coming up, Gottstein gone. Credit Suisse replaces its embattled CEO as the lender reports its third straight quarterly loss. We'll have more on that. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the Principal Room. Coming up later today, Ed Hyman, Evercore ISI Chairman. That's at 8:30 a.m. Eastern, 1:30 p.m. London time. This is Bloomberg.
We are going to refocus our investment bank into a highly competitive banking business and a much better aligned markets business. This is work under progress, and we will report to the market with the third quarter result.
That was the chairman of Credit Suisse speaking in Zurich earlier. The Swiss bank has replaced its CEO once again. Veteran banker Ulrich Körner will succeed Thomas Gottstein, who's resigning after 2 years marked by scandal and huge losses. Stephen Ahrens, Bloomberg banking reporter, joins us now. And Stephen, I guess for a while we wanted to give Gottstein the benefit of the doubt because he just came into the CEO role in February of 2020. Nonetheless, he just continues to come out with profit warnings. It doesn't look like he can really get to a kitchen sink quarter, and that's led to his ultimate demise.
Yeah, I mean, you're absolutely right. He was brought in to stabilize the bank after it was embroiled in sort of a spying scandal in the first place, and then all these things kept happening under his watch. He unveiled a restructuring earlier, late last year, that was sort of taking it easy on the investment bank, and clearly it hasn't been enough for the leaders of the bank. They decided more has to happen in the investment bank, and the CEO has to go.
What do we know about Ulrich Körner? How many quarters does he have in the hot seat?
Well, I don't want to speculate on how much he has, but he has a long track record at both Credit Suisse and UBS. He's been at either bank for, I think, 20 years now, and he was brought in not too long ago to manage the asset management unit at Credit Suisse after it came, after it suffered a blow from the fallout from the green cell funds. And so I guess he's been doing an okay job. They had to turn to someone who knows the bank and can stabilize it now. And let's see if he can deliver on this.
Let's see what this new strategic review unearths then. Let me ask you, let's pivot to Deutsche Bank, a story you follow very closely, I know, Stephen. How convinced are you by what they're saying on costs at the moment? Because they've stepped away from their previous cost target. They have a new cost target and an acknowledgement that some of those costs are not in their control, but very adamant that costs are not out of control.
That is true. They seem to be sort of out of control to me, actually. As you said, they have been scrapping cost targets left and right ever since really last year. None of the guidance or targets they have set on costs they've been able to meet. There's always something new. They always say it's out of their control, bank levies. But for example, they're setting aside now money to pay an expected fine for using unapproved personal devices as a pro in the U.S. And U.S. banks have said they are going to pay some money on that too. But, using personal devices is sort of in your control, wouldn't you say so? So, the claim all of this is out of their control, outside their control is not, seems a bit weird.
Stephen, just a broader overarching question. Now that we are back at zero in Europe, these banks have been waiting for rate hikes from the ECB for so long now. Now that they've actually come, but it's hiking into weakness, where does that leave them? Is it still a good thing?
It's a really good question. I mean, clearly the rate hike by the ECB to a neutral rate now is positive for banks, and Deutsche Bank actually upgraded its sensitivity to rate hikes, but other factors are offsetting that. If you look at another bank, UniCredit today, reported too, and they're actually upgraded their revenue a better rate environment in the euro area. So banks that are exposed exposed heavily to lending, they really benefit. A bank like Deutsche Bank, which has a very big trading unit, also faces other challenges.
Yeah, that UniCredit share price still up by more than 6% as, the business upgrades on that very subject that Kailey mentioned. Stephen, thanks so much. Bloomberg, Stephen Aarons joining us there from Frankfurt with the latest on the banking sector. And as a reminder, our special Fed coverage kicks off at 1:30 today, New York time, 6:30 p.m. in London. We'll be hearing from Diane Swank, Mohamed El-Erian and Bill Dudley, among others. This is Bloomberg.
We're watching inflation. We are, of course, watching central banks' reaction to that inflation with interest hikes. So it's something that we have to be mindful about. So far, we have not seen any reduction in demand for Mercedes. So demand for us currently is strong, but it's something that you have to have in mind and see how things develop into next year.
Mercedes-Benz CEO Ola Källenius there talking about inflation and the impact of that, as well as supply chain issues on his sales. Tom Keene now leading our Fed coverage today joins us to talk about what he's got planned because, with Ola and everybody else watching the Fed, Tom, got outsized importance?
It's got outsized importance. It'll be interesting to see what Mr. Powell does. I like what Krishna Gua says over at Evercore ISI, that we'll see if we have a Volckerized Powell. We'll talk about that through the show. Matt, I want to swing back over to the zombies of zombies, and that's the European banking system. We featured this through our American banks, and the basic idea up top is BNP Paribas actually doing okay for a European bank, maybe not a U.S. bank. UBS puts it together over the last number of years after a real struggle from the great financial crisis, and Credit Suisse just simply can't get it done. There's no other way to put it. They're down 93% from August of 2007. It's a complete, total zombie.
Okay, and we'll see whether there's any interest in that zombie M&A. A bit of a talking point in the sector. Tom, thanks so much. Tom will be back, of course, with further thoughts on the European banking space, but also, crucially, that Fed conversation. Let's get back to a sector that has been very much moved by the Fed conversation, and that is tech. We've heard tech earnings, though, and some points of resilience over the last 24 hours. Bloomberg's Matthew Bloxham joins us from Bloomberg Intelligence. Matt, very nice to speak to you. Let's delve into a few of the details here, then. The news we got, well, we were primed for something pretty negative, weren't we? Certainly around ad spend, because that had been the experience at Twitter and at Snap. It turned out other businesses could be more resilient.
Yeah, that's right. I think generally reassuring comments from and results from Microsoft and Alphabet overnight. Both grew revenues about 13% in the quarter year on year, maybe about 16% constant currency. I think for Microsoft, some strong messages that cloud spend by corporate clients is going to be resilient through an economic downturn. They said had their best quarter in terms of big orders, so that's encouraging. And on Google, yeah, the ads spend, you know, it was a bit mixed, but it held up generally pretty well. They've been less affected by some of the changes we've seen in ad tracking for Apple. Some effects from the TikTok rivalry, but less affected than some others.
So maybe up against YouTube, for example.
Yeah.
Back onto the Microsoft story, Matt. Is it convincing then when they say, as times get tough for businesses, they will spend more on cloud? Is that how businesses see that kind of tech investment?
I think so. I mean, I think that the inevitability for every corporate out there is that they need to do a massive overhaul of their technology infrastructure. I think one of the big attractions of moving to the cloud, apart from all of the kind of flexibility it gives you about how you can run your businesses, is that you can almost pay as you go. And so to some extent, you're smoothing out that investment profile and you can flex it up and down depending on how your business is doing. So given the greater uncertainty about the economic outlook, I think that is appealing to lots of corporates.
But to the point on uncertainty around the economic outlook, and especially the foreign exchange headwinds as well, do you believe Microsoft's guidance when analysts are calling it shockingly strong, shocking being the operative word?
I mean, we'll have to see, won't we? I mean, it's such an uncertain outlook. You know, obviously we saw the IMF cut GDP growth outlook yesterday. I think, you know, it plays across advertising too. At the moment, corporates still seem to be quite resilient in terms of their spending, both on their advertising and on their infrastructure. So, you know, there's clearly a risk that things are going to get tougher. But I guess for now, the assumption is that, yeah, things are going to get maybe tougher in the second half of this year, but perhaps, you know, we're not going to dip into a full-on recession through 2023. So, you know, I think it looks optimistic, and it probably does rely on a relatively narrow downturn.
And we get Meta later.
Yeah, we do.
And what's that story? It's advertising again.
Yeah, advertising again, but much bigger headwinds than we've seen at Alphabet. Probably going to report flat to maybe slightly down revenue year on year.
Okay, Matt, thanks so much. Thanks for joining us. Matthew Bloxham at Bloomberg Intelligence with his thoughts on the tech sector, the earnings we got after hours last night and the ones still to come. Meta, the big focus, as he says, for today. That is it for Early Edition. More surveillance is ahead with Tom, John and Lisa. And of course, there'll be that Fed special, so lots more on The Fed Decides. This is Bloomberg.